Hello everyone. Today I am going to give portfolio management tips to young investors. You will be probably thinking that am I eligible to give the tips or not? So let me start with my own story. Let me tell you something about my investment story. I started my investment when I was 20 years of age. I found that investment at an early stage is very important. It helps to plan and secure the future. I also made many mistakes and made bad investments, but eventually I learned from my own mistakes. I started to invest in crypto, stocks, FDs, etc. Whatever I was earning at that time from my blog or freelancing, I used to invest because at a young age you can invest in different things and take risks. I did some mistakes and lost a good chunk of my money, but I learned from my mistakes and bounced back. You know who is the smart investor? The one who learns from others' mistakes. So, my first tip for you is start early. Start at a young age. You will think, how I can invest? I don't have money. Chill. Everyone gets pocket money. You can save from it every month. After all, it's your future in which you are investing. Also learn more about investments, stocks, mutual funds, government bonds, etc. Every country has different schemes and systems, so you have to research what is available in your country and how you can start. Second tip is early allocation of higher risks. Another reason to start saving early is that the younger you are, the less likely you have heavy financial obligations like spouse, children, mortgage, to name a few. Without this burden, you can set aside a small portion of your investment portfolio for higher risk investments that can generate higher returns. When you start investing at a young age, before your financial commitments begin to build up, you will also likely to have more cash to invest and a longer time horizon before retirement. If you put in more money over the year, you will have a larger retirement egg. My third tip for you is start with an investment philosophy. It's easy to start with a flaming gun like me or shove money under your mattress. Instead of letting your emotions drive your investment, take time to reflect on your investment philosophy. Your investment philosophy should include an understanding of the stock market, expectations of market performance, and understanding of investment risks and your personality. And investment philosophy will prevent you from changing your strategy when market goes down or goes up, and it will help you manage the volatility of your portfolio. By establishing a philosophy, you define yourself as a long-term investor instead of a short-term player. My fourth tip for you is diversification. You know what is the biggest mistake I did when I initially started investing? That I didn't diversify. This means I only invested in one thing, which was cryptos. I made profits, but when the market went down, my whole portfolio went down. What I did, and you can also do, is I diversified my money. I invested some part of my portfolio in cryptos, some in stocks, and some in FDs, some in mutual bonds, and some in lending through trusted companies, and some spare money in my savings account for an immediate need. Because if one thing goes down, other will go up. It will decrease your overall risk and your portfolio will never be in negative or decrease. It will only appreciate with time. My fifth tip for you is discipline and regular investing. Make sure that you put money into your investments on a regular and disciplined basis. This may not be possible if you lose your job or you didn't get your pocket money or any other factor. But once your cash flow starts again, continue to put money into your portfolio. My sixth tip for you is tackle emotion with knowledge. One of the hardest things new investors face is dealing with their emotions. It is easy to doubt yourself, seek disproportionate returns, or flee to shelters. Rather than frame your portfolio with emotionally charged reports, new investors should shape their portfolio in the context of the market as a whole and the context of their strategy. My seventh tip for you is create and improvise your strategy. Analyze and study the market so that you can create your strategy for investment. Over the period, it will improve and you will learn and improvise according to your knowledge and experience. Over the long haul, a good strategy will allow you to maximize your long-term risk-adjusted returns. However, it is not easy to stick to your strategy when you face a never-ending barrage of investing information that might or might not be the next big thing. Guys, if you like this video, do give it a thumbs up and subscribe to my channel if you like my videos so that you will not miss any video in the future. And if you have any topics for me to cover, do comment down below. Thank you very much.